Good afternoon and welcome to the Midday Asian Midday Market Watch. I'm Samantha Voon, together with my co-host Brian Fernandez. And it's Tuesday, the 19th of June, and today we are joined by Zhang, Head of Equities at First Plus Asset Management. Jiang, good afternoon.
Good afternoon, Samantha. Good afternoon, Brian.
Hi, Jiang. Now, Jiang, before we get your insights, let's take a quick look and see how markets have performed in the first half of the day. We're going to start with the ASX All Ordinaries. That's down slightly, 0.17%. The Kospi is up 0.9%. The Nikkei 225 is up 0.18%. The STI index, where you're at, Jiang, is up marginally 0.40%. The KLCI is down 0.23%. The Hang Seng is up 1.86%. And rounding out the numbers is Shanghai, which is down 0.38%. What's your view on market performance in the first half of the day?
Well, so Brian, I think right now we're seeing growing investor interest in terms of the Hong Kong listed equities, as we've seen today by the nice outsized growth in the overall index, right? So I think the strength in the overall Hong Kong equities for the past, since January, has been driven by a few factors. One would be the initial signs of the consumption stimulus that's coming out of China, and the other one would be the attractive valuation that's been attracting a lot of these foreign institutional investors that have left China, but they're increasingly coming back to China.
Mm-hmm. So we've seen, like you mentioned just now, Hong Kong equities have rallied, since January. So what's your view, and how sustainable is this? Yeah.
Well, I mean, this is a very good question, right? Over the past, so if we look at over the past 3 years, right, the Chinese equity market has been quite challenging. And we've been getting a lot of questions from our investors as well on the sustainability of the equity market. Our view is that the Chinese economy is certainly running below potential, but we do not think that China is collapsing. Okay, and after 3 years of underperformance for the MSCI China Index, we do believe that we're close to the tail end of the bear market, and that China's current valuation remains quite attractive for any investors wanting to add China as part of their long-term investment strategy. So if we were to think about the factors that's driving the sustainability of the overall market, I can think of two factors specifically. One would be on the ongoing policy support on the consumption side, and also the attractive valuation as well as the shareholder return. So I just want to elaborate a little bit more. So on the consumption side of things, so we are seeing an increasing number of policies that's designed to drive the demand side of the equation. So specifically, if you look at like the property market, down payment ratio and the mortgage rate has been lowered. Some of the purchasing restrictions on housing in major cities have been lifted. And then there's the other stimulus measures that drives large ticket purchases like home appliances, furnishing, as well as electric vehicles. One thing I would like to point out is that although these things are very early days, and it may take some time for the impact to trickle down to the overall economy, we do think this is a positive signal. And whatever comes out from the third plenary session in July regarding consumption stimulus, or whether it's like improving social safety net, we think those things will be taken quite positively by the market. So that's one thing. And another thing would be the...
Can I interrupt you? Just
Sure.
One point there, because it's related to consumption. And the Western media tends to play up the fact that consumption, particularly, and if you use one barometer, car sales as a barometer, they've fallen off a cliff. You have large inventory buildup. You have overcapacity in terms of production. How long do you think, in your view, will it take for the economy to kind of grow itself out of trouble from a consumption perspective?
So I think that's the $1 million question, right, Brian? I do agree that there is a weak consumer sentiment within China, and this has been ongoing for the past 3 years. I do agree that there is an overcapacity challenges, and that's why China has been driving a lot of the export just to destock some of the overcapacity issues. But if you look at some of the latest retail sales data that's coming out in May, it was actually slightly higher than expectations, a bit by a lower base. But we do think that this is the initial signs of a positive signal that consumers may be starting to come back. But keep in mind that although the consumption trend is somewhat mixed, consumers are still spending, but they're becoming more selective. Although some of the ultra luxury brands may not be doing so well, but we do think like the mid-end brands, as well as some of the value for money brands within China, they are doing extremely well. So if you look like platforms like PDD, that's actually gaining share within China's e-commerce market. So at the end of the day, consumers are still spending, but they're just been a little bit more cautious and a little bit more selective.
Okay, so given that perspective, then Jiang, where should we be putting our money in terms of stocks?
Well, so our view when it comes to investing in China is that given the mixed situation in China, we do not recommend investors to have a broad investment themes going into China. So investors still needs to be very selective. So from our perspective, we do like stocks that are able to do well within China's domestic market, but more importantly, expand globally. So in other words, we like the Chinese companies that could potentially become the next global player. I mentioned PDD in your show previously. We are still very positive on PDD, not because, like I said, PDD has been gaining share within China's e-commerce market, but more importantly, PDD's Temu cross-border e-commerce platform has been gaining share in the US as well as in Europe. And they recently just got into Brazil, which is another big e-commerce market. But I think, more importantly, it comes down to valuation. So if you look at a lot of these companies within China that's been trading at a very attractive valuation, PDD currently trades at 12 times forward price to earnings ratio. And we do not believe that the current valuation is reflected on Temu, which we think could add an incremental 30 to 50% upside to PDD's current valuation. So that's one stock that we actually really like. And the other stock that we're actually quite positive on is BYD. Since you mentioned auto, we actually like BYD. So we like BYD not because it's the largest Chinese automaker, but also the largest EV maker. We like BYD because we see a clear economic moat for the business model. So specifically, its vertical integrated model allows BYD to enjoy a very solid scale, economy of scale, and also technology leadership within battery. So when you factor all these things together, we do think that BYD is in the early days of becoming a premier global Chinese automaker, similar to what Toyota was like, say, 80 years ago. And the current valuation of 18 times earnings with a 20% revenue growth as well as 20 times earnings growth, we do think the current valuation is actually quite attractive for a company that could potentially become a global player.
Interesting. So Pinduoduo and BYD stocks really to watch, and I'm going to take your word for it and take a look at that. But Zhang, before we leave, we're coming to the end of the first half of the year. I think overall, mixed bag overall. Looking ahead to the second half of the year, what are some of the risks we need to be watching out for that perhaps could move markets?
Well, that's a very good question, right? So second half of the year, we are the key headline going in would be the U.S. election, right? And right now, the consensus, there is no clear consensus on where the U.S. elections will go, and the result of the election could become a key determinant of the Sino-US relationship. And the geopolitical risk with US and China would be the single biggest risk for the Chinese equities market, not only from I would say, from an external perspective, but also for companies, like BYD and PDD, which are susceptible to geopolitical shocks within the global market. So that's one risk. And I think another risk would be the China's domestic issues. So although we're seeing green shoots of the Chinese economy start to see a little signs of recovery or maybe like stabilization, we do not rule out any outsized or unpredictable risk that's happening with the economy, specifically with the property market as well as the overall consumption trend. So these, I would say, are the two single biggest risks as we head into the second half of the year.
All right. Thank you so much, Jiang, for all of the insights.
Well, thank you very much, then, Samantha. And thank you very much, Brian. It's good to be here.
You.
Yeah. So we've been speaking to Zhang, Head of Equities at First Plus Asset Management on BizTech Asia Midday Market Watch. I'm Samantha Voon.
And I'm Brian Fernandez.
This video and podcast will be on our website, www.biztech.asia, our social media platforms, as well as our syndication partners' TV stations, radio stations, and website. Please like and subscribe. Thanks for tuning in.